Shares of DataDog, a SaaS specialist focused on observability, are down over 18% today as the company reported earnings last night. So, what's going on with DataDog and should investors be concerned? My name is Brian Stoffel. We'll spend the next 10 minutes finding that out. As of the time of this recording, I do own shares of DataDog. Want to give a shout out to YCharts for sponsoring today's video. More from them in just a minute. So this was Datadog's second quarter of 2023. After today's fall, it's about a $28 billion company. On the top line, good news. Revenue was up 25%, and that was ahead of both Wall Street's estimate and the midpoint of management's guidance. On the bottom line, 36 cents per share on an adjusted basis was up 50%, and it beat Wall Street and management's own guidance. Look at margins on a non-GAAP basis, a lot to like there too. Gross margins expanded and remain over 80%. Operating margins were flat but still very healthy on a non-GAAP basis. Net margins were up significantly, up to nearly 25%. Free cash flow more than doubled from $60 million to $142 million. Net income was up as well, and the balance sheet remains in very good shape. So let's look at some of the key numbers for the company. Now, one thing to focus on here is that their dollar-based net retention rate had been over 130% for as long as the company had reported it, but this quarter it dropped to 120%. Now remember, that means that existing customers that were there a year ago were on average spending 20% more with the company. That's still a very healthy number, but it was down. The company talked a whole bunch about large customers optimizing their use of Datadog, which basically just means using less or growing less than it has in the past. And it's basically just a way of cost cutting. I hate how all companies use that, but that's basically what it means. Companies are looking to save money and are growing their expenses on Datadog at a slower pace than they have been in the past. Should you be concerned? Well, let's look at the rest of the numbers. Total customers was up 23%. Customers paying more than $100,000 per year was up 24%. And then there are all these numbers right here about the percentage of customers using 2+, 4+, and 6+ products. I like to look at this on an absolute basis, so I created my own chart that shows this. And what it shows is that the number of customers using 2 or more of Datadog's products has grown 28% over the past year. Using 4 or more was up 50% over the last year. Using 6 or more was up 85% over the past year. Now, this is a very important figure for me because it shows a combination of both moat and optionality. That moat is because the more tools that a company uses that Datadog has, the more ingrained this becomes in that company's standard operating procedure. The switching costs are very high, but there's also optionality because Datadog has rolled out lots of new products since it came public over 4 years ago, and those products are being adopted by customers. So this is a really important 1-2 punch. So while a lot of investors might be worried about today's drop, the company itself is still executing quite well. Now let's turn to guidance because that's where the real problem comes in. Management guided for 20% growth on the top line midpoint. That was below Wall Street's estimates, even though earnings per share are expected to grow faster than Wall Street expected. Before today's announcement, management was expecting 25% growth on the top line, 19% on the bottom line, and basically after today they switched. They lowered their top line growth to just 23% and raised their bottom line growth to 35%. So overall, that's the main thing that's got investors spooked. We'll show why it's such a big reaction in just a minute. Now, moving forward, what should investors watch? First, keep an eye on that dollar-based net retention rate. It dropped to 120% plus. I would expect it to stay there. You cannot stay at 130% plus forever. Second, multi-product usage. Keep an eye on that continuing to grow. The growth rates might fall, but hopefully not too much. Third, keep an eye on free cash flow. And fourth, keep an eye on the outlook because we want to know, is this a problem that is going to keep affecting Datadog? What do they see coming down the pipeline? Keep an eye on that. Overall, I think that the moat for this company is still widening and that the thesis is very much on track. In fact, when we run this through our quality checklist the last time, I gave this a 13. Brian Feroldi gave it an 88, still very much in the anti-fragile territory. But now we have to turn to valuation. Now, if you look on July 31st, a little over a week ago, even though I own this stock, I said, look, this is the company whose valuation is really the most insane. And we'll see, has that changed after today's drop? And for that, we have to say, well, what stage of the growth cycle is this company in? And I would say it's between stage 3 and stage 4. So we can look at things like price to forward earnings, price to free cash flow. And for that, we go to Y charts, a tool that Brian Feroldi and I use every day. If you click on the link in the show notes below, you can start a free trial at Y charts. Mention Brian Feroldi's name, you get 20% off for your subscription. So on a forward PE ratio basis, Datadog now trades for about 73 times forward earnings. Look, that is expensive no matter how you look at it. On a price to free cash flow basis, trades at about 80. If we factor in the free cash flow growth we just saw, about 66. Again, that is very expensive, but we can also look at a reverse discounted cash flow analysis. And if we do, we just type in the ticker symbol right here, Datadog. We put in the trailing 12-month free cash flow of $422 million. We give it a discount rate of about 10%, terminal growth rate of about 2.5%. Maybe 3% because this is a fast grower. We put that in and then we say, well, what kind of free cash flow growth does the company need moving forward? And we could type in 20%. We got to get these numbers to match. That's not quite there. What about 23%? That puts us at about there, maybe 23.5%. Now, overall, do you think the company can accomplish that? Well, its free cash flow margins are actually pretty high right now. They could get a little bit higher, but basically we're saying, could they grow 23% moving forward? Unfortunately, when we look back at what the management is expecting, we see that they're expecting for the full year for about 23% growth this year. So keeping up that 23% growth moving forward indefinitely, that sounds like a pretty tall order. And so I would say that the valuation is still not very attractive. It's nowhere near as ridiculous as it was even a week ago, but it's still not super attractive. Does that mean I'm going to be selling shares of this company? No, absolutely not. Because I think that it has the 1-2 punch of a wide moat and lots of optionality. I'm not going to be adding shares at today's prices, but I'm not scared away from it either. Look, the other thing that's worth noting on the conference call was the fact that the company said that they were seeing a lot of other of their customers using more of their tools, and basically they were going away from other vendors and saying, we're just going to consolidate all of our SaaS observability tools under Datadog's umbrella. So I wouldn't be surprised to see that revenue growth possibly even accelerate over the next 2 years, but we'll have to wait and see if that happens. Overall, I am still a very happy shareholder of this company. This is just part and parcel of what comes along in investing in companies just like this. If you're interested in a discounted cash flow, a reverse discounted cash flow tool like you saw me using, click on the link in the show notes below and you can get that. Otherwise, we'll check back in on Datadog in 90 days. Until then, Brian out.